You're listening to the Alan Gray podcast. I am Rory Katiska-Jacobson, one of the portfolio managers at Alan Gray, and your host for this episode. Alan Gray is celebrating a special milestone this year, 50 years of investing. Over the last 5 decades, we have always put our clients first, and we would like to thank you for placing your trust in us. We work tirelessly to ensure that your trust in Alan Gray remains well placed. Joining me for this conversation is my colleague and friend, Matthew Spencer, from our offshore partner, Orbis. Matt is based in Bermuda and heads the team of investment counselors who are responsible for servicing Orbis's institutional clients and investment consultants. The global stock market boom we have seen in recent years seems to be making way for a stock picker's paradise. In this episode, we will delve into the major global themes that are shaping the opportunities for long-term investors. Matt, welcome. You're originally from Joburg, but as I understand it, you moved to Bermuda to get a job. Could you not get a job in Joburg?
Firstly, thanks for having me. It's good to be back in the mother country. And that's right, I did leave Johannesburg 20 years ago. I could get a job. I was with PricewaterhouseCoopers. I was coming to the end of my training contract, and essentially, you could go and finish your training contract off in New York or San Diego or Bermuda. And when I heard about Bermuda, you can understand that got me excited. And one of the reasons that it did get me excited is that I knew that the person, Alan Gray himself, lived in Bermuda. So I thought, let me go over with PwC, do my 18-month contract. But before I left the island, I promised myself that I would find him and introduce myself.
So you were the original Alan Gray fanboy. I mean, how did that go? How exactly did you find him or hunt him down?
I didn't. I tried pretty hard, and I used my connections. I mean, Bermuda's a tiny island. What you find is you build up a bit of a community. And person that I played hockey with was Alan Gilbertson, who was a former president of Orbis. And I said, okay, well, this is my in. And cut a long story short, he wasn't able to arrange a meeting with Alan, but he was with Will Gray, which is Alan's son. So Will and I met. I don't think he was particularly impressed, but, I kept coming back and trying. And, after 9 interviews, I think 3 IQ tests and a personality test, I finally got through the door. And since then, I've never looked back.
And I guess it helped with the low population in Bermuda. I guess you've been relatively fortunate then to be with Orbis ever since. And one of the benefits, I guess, of being based in Bermuda is you actually worked alongside Will and Alan. I don't know if you have any interesting anecdotes or stories that kind of stand out for you in thinking about what it was like to work with Alan.
When I started at Orbis, my mentor was Craig Bodenstab, and I learned so much from him, but he was very militant, and he would sort of breathe the fear of God into you. And, I remember him saying that Alan, one of his strategies is he would invite you out for lunch or dinner, and he'd ask you questions that he knew the answers to see if you were a fool or not. And he'd really grill, whether it was the CFOs or the CEOs of different companies. And so, you always got to watch out if you're going to dinner or lunch with Alan. And so I'd heard this, and, it wasn't only Craig who said this. And, one day I was sitting in my office in Bermuda, which was just diagonally across from Alan's. And it was about 3:00, and all of a sudden he strolled in. And he was like, Matt, what are you doing for dinner tonight? And I was like, no plans, Alan. He goes, well, would you like to come to my house for dinner at 6:30? And I was like, that sounds lovely. Just may I ask, Alan, how many of us are going to be at this dinner? And he was like, no, it's just going to be you and I. So I was like, okay. Is there any topic in particular that you want to discuss? And he said, yeah, there is actually. I believe your wife is from Guernsey, and we're looking to open up a presence in the Channel Islands, and I want to learn all about Guernsey. And I was like, you've come to the right spot. I know all about that. And anyway, that afternoon after 3:00, I was on the internet just scanning, learning everything I could about the Channel Islands. By the time 6:15 came, I said, I better jump on my scooter and get up there. And I thought, you can't pitch up empty-handed to a dinner party. You better go, buy a nice bottle of wine. And so I went to the local bottle store. And what kind of wine do you buy for Alan Gray? Someone who's got everything. You buy the most expensive wine, he's going to think you're a fool. And you can't pitch up with, your everyday box wine. So anyway, I saw this Chianti Classica, I'll never forget, and it was, 2 for the price of 1 or some sort of deal. And I thought, Alan's all about value for money. He's going to love this. And so I pitch up at his house with these 2 bottles of wine, and then I'm thinking, oh, hang on, you can't have 2 bottles of wine. You look like it's some sort of frat party or something. So I put the one back in my bike and went in, and yeah, I think it was about either between the starter and the main course or just after the starter where Alan realized that he knew more about Guernsey and the Channel Islands than I did. But it was a great evening. We spoke about books we had read and his plans for the philanthropy and the stocks he was interested in, and it was fantastic. And I remember on the scooter ride home thinking, I think I've got away with that. I don't think he thinks I'm a complete imbecile. Next day I'm sitting at my office, same time by 3:00, comes into my office and he's like, Matt, what are you doing for dinner tonight? I'm like, oh no, here we go again. And I said, no plans, Alan. So he said, well, same time at my house at 6:30. And I was like, I knew I was a hit. It was what was going through my head. I said, yeah, sure, no problem. I'll see you there. And then just before he walks out, he stops and turns around and says, but this time, can you bring your wife? Because I'd really like to learn something about Guernsey. So I phoned my wife up and I say, listen, we got dinner at Alan's house. And she says, that's very sweet, but I've got netball practice. And I said, no, you got dinner at Alan's house. We got to get there. And she's like, you're so last minute. Okay, I'll go pick up a bottle of wine. And I was like, don't worry about it. I'm one step ahead of you. And so that's a fun memory I'll always have of Alan. But he was fantastic, very focused. He'd beat me into the office every day and work later, and he would just sort of burn holes through the pages in a very average-looking office, just doing what he loved, and that was stock picking.
That's an amazing story, and I think that talks a lot about the man as well. Maybe before we move on to markets, just kind of one last question about Bermuda. So one of the challenges we're kind of dealing with in South Africa at the moment is load shedding and the lack of power. Are there any particularly unique challenges that you face within Bermuda? I mean, is the grass greener on that side of the ocean, or?
So it is a fantastic place, I've got to say. I mean, I've made a lot of bad decisions in my life, but Bermuda and my job and my wife are certainly not one of them. And Bermuda is fantastic, but it does have its problems. Unlike the electricity here, our problem there to a large extent is the water, because of course there's no dams or rivers or anything like that. It literally is a 40-kilometer long rock and 1 kilometer wide rock. It's just this thin little island in the middle of the Atlantic. A lot higher than people think. It's sort of in line with North Carolina, and so we don't have any sort of natural water. So if you look at the houses in Bermuda, they're very distinct, and they've got these spiral-like roofs. When the rain comes down, it spirals down these limestone roofs and goes into tanks underneath the house, and that's where you get all your water from. So every now and again, when it is particularly dry, we can be in a bit of a tough spot with the water, but not the electricity.
Okay, well, let's move on to markets, Matt. What does the global landscape look like at the moment to you? What stands out?
If you look at our portfolio, and we're always a little bit, reticent to speak to themes because we bottom-up stock pickers, but, one thing which is clearly obvious is that we've never been more overweight your old economy or value stocks in our global portfolio at the moment, more so than just before the tech bubble burst. So 70% of our portfolio now is in what I would call value stocks, and there's 4 buckets. We've got your critical infrastructure and energy. You then got your quality cyclicals, like a semiconductor chips and interactive brokers. And then you got your banks, and then you got a catch-all bucket, which is everything from BMW to a US logistics company. And I think, what's led us there has been our bottom-up stock picking. And, why it's led us there is that, you look at what the environment that we've had since COVID, where you had all this stimulus which was pumped into the system. And, got to the extent where you were an American sitting at home, locked away, and checks were arriving, at your doorstep, and you couldn't do much because you're locked away. Spreading bad ideas on social media and accessing the markets has never been easier. You could open a Robinhood account in the space of 4 hours. And so all this money flooded into the market, and it pushed the value of the market up quite considerably. And that's been, well written about. What was less written about is that there was a clear bifurcation or fault line between sort of new economy or growth stocks and your old economy and value stocks. And so the former got insanely expensive. And it's not surprising. Whenever there is loose money in the system, it seems to chase the new shiny item. And so your tech stocks, for example, got really expensive, where your energy and your commodities, etc., those remain quite cheap. And so through our investment philosophy where we're not going to overpay for companies, it's led us to more of these old economy stocks.
And if you look at what's happened more recently, I guess there's also a divide even within the tech space where you've seen some of these new age or kind of unproven tech businesses that ran incredibly hard, but then in the last 12 to 18 months have fallen 50, 60, 70%, the likes of Carzuka, Beyond Meat. But then at the same time, you've seen a significant further rally or additional kind of bifurcation between the large mega tech stocks and the rest of the market.
And that's right. And so, you shouldn't really speak with tech with one broad brush, and which I have been doing. So that is true. I mean, the real speculative stuff, as soon as rates started to go up, those were the ones that were crushed first. Now, I don't think they cleaned out altogether, but they have had a tough time. And now your more established companies like your Facebooks, your Amazons, your Netflix, your Googles, or Alphabet, et cetera, they have come down a bit, and their valuations are starting to look more reasonable. But we are looking at them. There's no doubt about it. And in fact, there's a small position in Alphabet which has come into the portfolio, but they're not quite cheap enough, we don't think, just yet, in order to dislodge these old economy businesses. And I think the one thing that we would point to is that if you look at the valuations that they're trading at now, if they're to warrant those valuations, then the next 10 years is going to have to be the same as the last 10 years. And it's just been fantastic for those companies in the last 10 years in terms of the growth that they've seen. I mean, they're all $1 trillion companies, some are $2 trillion companies. And if they're going to keep growing at the pace that they have been growing, then, they're either going to have to start eating each other's lunch, which we are seeing. I mean, Microsoft trying to get Amazon's cloud business, and, Amazon trying to get Netflix's streaming business, et cetera, et cetera. When that happens, your margins start getting compressed. And so you don't have the earnings power. So that's something that we do worry about. Or they're going to have to start going into other markets. And if you think they're going to start breaking into China and other markets, I think that's very unlikely. And so we are watching them, not quite cheap enough for us just yet to be getting in.
And I mean, I guess further to that, there seems to be a lot of positive sentiment around artificial intelligence and what can that mean for some of these larger tech stocks. You've seen ChatGPT, Alphabet has got a competing offering through Bard. And then I guess at the most extreme part of that is something like NVIDIA, which is a market cap of just over $700 billion, trades on 29 times revenue.
That's dead right. I mean, this artificial intelligence, I think people are finally coming to realize how it is going to change our civilization and how powerful it is going to be. But we don't know who's going to win the race. We don't know whether it's going to be Google or Microsoft or a company that we'd never heard before, whether it's going to be the USA or China. And so, the strategy that we're playing there is, one thing we do know is that they're all going to need these semiconductor chips. There's no doubt about that. And if you look at the semiconductor industry, you can really slice it down the middle. On the one side, you've got logic, the logic chips, which is, makes your phone so smart and your computer do all the cool stuff that it does. And it's really what AI is going to run off. And you mentioned NVIDIA there. That's where they would fit in. They actually don't make the chips, but they would design them. So, becoming so complicated to design now. And then they would give it to something like Taiwan Semiconductor to make the cutting edge chips. And those aren't the semiconductors that we're that excited about. What we're really excited about is the other side of the industry, which is your memory chips. What we like about that is it's far more of a commoditized industry. In other words, a memory chip from Samsung is the same as a memory chip from SK Hynix, et cetera, et cetera. And so in the past, this is an industry which has just been absolutely brutally cyclical. And you'd get these companies that would invest between $10 and $15 billion to get a fabrication plant up and running. And when you spend that kind of money, you want to make sure you're pumping out as many memory chips as you possibly can. And inevitably, this would lead to an oversupply. The price of the memory chips would crash. And then it was just a battle of attrition. Who can hang in there the longest? And even governments would step in and support their local champions. And but inevitably, companies then would start going bankrupt. But those companies that were left around would make super profits. So if you could spot the bottom of the cycle and back the winning horse, you could do fantastically well. And there were 14 companies back in 2000. As we've gone through the cycles, there's only 3 left now that make these memory chips. And they're starting to behave a lot more rationally. And it's Samsung and Micron in particular that we're interested in, two companies we've looked at, for 20 years. So we know what to look for. And just looking at how they cut in their capital and how the inventory is starting to be cut back as well, we believe we're pretty close to the bottom of the cycle. And so that's how we playing this whole sort of tech space, is to use that analogy of the gold rush, where the people who made the money were the people who sold the picks and the spades to the people digging, rather than backing a particular person digging for gold. So we've got a fairly sizable position in those semiconductors.
And I guess Samsung's a little bit unique in that they participate both in the memory chips and the logic chips.
Yeah, so that's right. They are an incredible company. And on the logic side, I think the thing I'd underscore there is that it's got so complicated to make these chips that there's only 3 companies now that can make the latest and the greatest chips, and that's TSMC, which is Taiwan Semiconductor, Samsung, and then Intel, and maybe I'm being a bit generous including Intel there. But, when you hear that and you hear all about AI and how it's going to transform civilization, and Taiwan Semiconductor is one of those companies, you can see what all the hoo-ha around Taiwan is about.
Okay, and if we just come back to one of the other pockets where you said you were finding value, it was in the old economy stocks, the energy stocks. If you can just unpack why you have conviction in that particular sector?
Yeah, so the reason is that, energy is just extraordinarily cheap, right? And there's been a huge underinvestment now for more than a decade. It's something we've been excited about for quite some time, and overweight energy. But if you look at the names that are in the portfolio now, they're slightly different to the names that were in the portfolio, say, this time last year. Previously, you would have seen, the Shells and the Chesapeakes and the companies that are getting the stuff, out of the ground. And if you look at it now, it's more your Schlumbergers and your Kinder Morgans. And so those are the critical infrastructure. And then another theme which is rising in the portfolio is looking for those energy companies that are going to be part of the transition from fossil fuels to renewables, but are priced like they're part of the problem, but are actually moving to being part of the solution. And so a company there which springs to mind is AES, which is a big US utility. So I think of it as Eskom on steroids. I think it provides energy to actually 14 countries. And it's a fantastic company. It's
Eskom doesn't provide energy to one country, just to be.
Yeah. So way better than Eskom, but and it's great. It's got a good dividend yield. It's got good growth prospects. It actually generates something like 40% of its power from renewables already. Yet it trades at a 40% discount to its peers. And so this is the kind of stuff that would ping up on our radar, and we say, hang on a second, that doesn't make sense. What's going on here? And when you look underneath the hood, what you'll notice is that, still 20% of its energy is generated from thermal coal. And thermal coal is really the one fossil fuel which is uninvestable, and a lot of asset owners, whether it's pension funds or whatever it is, just won't touch it, right? And if you do a little bit more digging, what you would find is that they're investing a huge amount in solar and grid-scale battery and all this great renewable stuff, but more importantly, they're slowly getting rid of their coal, right? So if we're having this conversation in 2018, 50% of their power was generated by coal, and that's been coming down to 25 and now down to 20%. And by 2025, maybe 2026, they're going to have no more coal left. And so we would expect it to re-rate, and you're slowly starting to see that in the price. So that's a kind of like dislocation we're looking for, that if it does play out right, it'll be great for our clients, it'll be great for the company, and great for the environment.
Okay, that's a really interesting point, I guess. And the whole energy transition is extremely topical at this point in time. And I guess one of the most misleading acts of government in the US has been the Inflation Reduction Act, which I think the name is incredibly misleading, in that if they're going to spend the level of spending that they're going to incur, it's more likely to result in inflation than not.
Mm-hmm.
And so just how are you thinking about inflation, how that's impacting the portfolio?
That's an interesting point, and it's deeply complicated, but to try and simplify it, I mean, if you go back 40 years now, right, you had these huge deflationary pressures all around the world. You had, Reagan and Thatcher that broke the trade unions back in the 80s, so you got access to cheaper labor. That labor got even cheaper when China joined the World Trade Organization. Now every red-blooded capitalist in the US was shipping off its its production to a cheaper area like China, which was hugely deflationary. You saw the end of the Cold War, so countries no longer had to spend 2 or 3% of their GDP on arms. So that was deflationary as well. And then, of course, you had the global financial crisis, and central banks basically had to take interest rates all the way down to zero, which again was deflationary. And, you live in the Western world and you really haven't known inflation, certainly like you know it in South Africa here, for quite some time. And we feel that some of those deflationary headwinds are now turning the other way, right? I mean, your wage bill is going to get a lot more expensive. I mean, I think this is a great chart that we have. It shows that there's something like 1.7 jobs for every American looking for a job in the US. And what does that tell you? If you want to keep your talent, you're going to have to start paying more, which is going to be inflationary. You've also got the end of the peace dividend. This rise of the war in the Ukraine, people are going to have to start spending money on defense. That's not productive. So it's going to be inflationary. And then to your point, if we are going to go green and more renewable, I read a piece by GMO that if we're going to actually commit to what we've agreed to in the Paris Accord, it's going to cost us $100 trillion, right? And it might be money well spent. It might save the human race. But regardless of what you think in that regard, it's going to be inflationary. And so, inflation is definitely something which is on our minds. And, you look at our balanced fund in particular, I think it's doing a great job of protecting our clients' purchasing power. And, how it's doing that is, it's staying away from government bonds to a large extent, which we think are expensive, and it's replacing it with things like gold. So we've got about 10% of the portfolio in gold at the moment, which is quite high.
And is that just pure gold or gold and gold shares?
Yeah, so it's a mixture of the two. About 5% of pure gold and 5% of the gold producers, like Barrick Gold in particular, which we like. And then we've got tips as well. So inflationary protected treasuries. So you get an increase of your purchasing power by 1.4%, then plus whatever inflation is. And you'd think that everyone is petrified of inflation because you open up the Financial Times, there's always an article on inflation, BBC, you name it. What it's actually priced into the market, it's 2 to 2.5% for the next 10 years in the US, which seems too low for us. So the other thing we're doing is, instead of going into bonds, we've also got quite a large exposure now to hedged equity, which is essentially in our balanced fund. It's quite a large portion, and it's essentially optimal. So what you get with that hedged equity is the cash return, which is about 5%, and then any outperformance Orbis stocks beat the market by. So we have nice alpha. You could get 5%. We have 5% alpha. That's a nice 10% return. And then, of course, in the equities that you look at, we're favoring these old economy businesses. And why are those so great? Because to a large extent, they are inflation protected, so they can increase their prices with inflation. They're churning out cash flows right now, not far out into the future, and so really, a bunch of real businesses, old businesses, but ones that can retain their purchasing power.
And the other interesting aspect, I guess, of that is, in the old world economy stocks, you haven't seen this gold rush or this suddenly huge amount of capital coming into those sectors. In fact, if anything, the producers and the manufacturers have stayed relatively capital disciplined.
So that's right. And you haven't seen a mass influx of capital. So the stocks are cheap and they're churning out good cash flows. I mean, you look at some of our energy stocks. I mean, they had free cash flow yields of between 15 and 20%, which means that they can, buy back the entire company in the space of 5 years with the cash that they're churning off. I mean, it's absolutely crazy. Where you look at some of the tech stocks, even the good big tech stocks that we like, some of them have a free cash flow yield of between 3 and 4%. So to take them, 25 to 30 years to buy the entire business back. So it just goes to show how incredibly cheap and beaten up they did get. And of course, with our philosophy, that's where we would end up.
And so I guess it's important maybe just highlight is you don't bake into your valuations or models a re-rating. It's more based on the pure fundamental economics.
Yeah. So, it differs from company to company. So, for example, AES, we'd be baking in a re-rating. But in other companies, I suppose one that you own as well, Glencore, I don't think we're expecting a particularly big re-rating there. That would be more, dividends and share buybacks.
That's certainly how we value it this side. Is, yeah. We're not expecting someone suddenly to pay us 13 or 14 times for half the business, which is thermal coal mining. And then maybe just on the buybacks, the one thing that I would also like to maybe highlight is when we evaluate these companies, we actually look at the share register and whether buybacks are resulting in a reduction in the shares in issue. Because what you've certainly seen in the US over the last few years is any number of companies buy back shares, but in actuality, that's just another form of stock-based compensation for their employees. Because if you look at the bottom line, where the absolute number of shares in issue are, they're not shrinking, they're growing. Whereas for a number of these old economy stocks, you are seeing a reduction in the shares in issue. And so those buybacks are real. And then I guess one other topical issue worth probably discussing, it's been all over the news the last few months, is the banking crisis that started in the US. Maybe just your high-level thoughts on what's transpired there.
So I think that was particularly disappointing. Probably not for the reasons that you think, but the key takeaway from the mini banking crisis in March was that the market stepped back and said, you see, central banks can't raise rates because when they do, the whole system falls apart. And why is that important? Well, that's important because then investors have said, okay, well, then let's dust off the old playbook that worked so well in the old cycle, and let's go back to these new economy/growth stocks, and let's forget about the value stocks. And so you would have seen that March would have been an awful month for a firm like Orbis, where we overweight these old economy stocks. And so what did happen with this whole banking crisis? Well, on the one side of the Atlantic in Europe, you had Credit Suisse collapse, and then on the other side, you had a number of US regional banks collapse. First it was SVB, followed by Signature and First Republic. And I think, the two most important things first, we didn't own Credit Suisse or any of these regional US banks. In fact, we didn't own any US banks whatsoever. We did look at them, but I think the conclusion we came to is that they were too expensive and that in some cases they were carrying, unnecessary risk. And then the second question we're getting all the time is, hey, is this another meltdown? Is this another 2008? Where we're going to see a meltdown of the banking system? Our answer there is we don't think so. And the reason for that is that the banking system is far stronger. It's better capitalized, so banks can absorb shocks far better. They've been far better disciplined in writing their loans. The regulators have had their eyes on them, so there's less shenanigans. And of course, those toxic assets of your CDOs and your CLOs and your ninja loans, those have been flushed out of the system.
Just maybe for the interest of the average listener, what is a ninja loan?
So your ninja loan, the first time I came across it was in Bermuda when I was auditing for PwC, and we were looking at these kind of securities. And, I came across ninja loan, which I thought was a really cool name for a loan, until I learned that the ninja stood for no income, no job, or assets. So, hey, listen, if you don't have any income or a job or an asset, don't worry about it. We got your back. We'll lend you a whole bunch of money. And then we'll take it and we'll wrap it up and securitize it and put it into tranches along with a whole bunch of mortgage-backed securities that no one really understands and inject it far and wide into the system. And that was essentially the sort of the credit event we had in 2008, which caused the meltdown. So it's unlikely we're going to see that. But there is one big caveat that I'd say is that just by the leveraged nature of banks, it is a sector of confidence. So if you have a fundamental vacuum of the confidence out of that sector, then, they would fail. But we think that's incredibly unlikely. And so, the question is, well, then, if it's not so bad, can you tell us what happened with these regional banks in the US? And, you start with SVB, and, SVB starts with Silicon Valley Bank. And, as its name suggests, it was the bank of choice for these tech startups and these venture capitalists. So, it's never been easier in the last couple of years for these tech startups and venture capitalists to raise money. So they'd have this money. They needed a bank. Silicon Valley Bank was their bank of choice. They would give them the money. Silicon Valley Bank would keep a bit of cash on hand, maybe 8%, and then this is where they made the big mistake. The rest they would put into long-dated bonds. And why is that a mistake? Because, of course, if you put them into long-dated bonds and interest rates go up, those bonds are going to get absolutely hammered because there you are holding a bond that's going to give you below market rate for a long period of time. Now, shockingly, this could have all been avoided with simple interest rate hedging. But SVB were without a risk manager for more than a year, so they didn't do that. Left a huge hole in their balance sheet, and rumors started swirling around. And of course, when these venture capitalists and tech startups all speak to each other, so they all went for their money at the same time. You had a classic run on the bank, and then the FDIC and the Fed had to step in to stabilize the system. Then all of a sudden, if you're in a regional bank in the US, you're thinking, hang on a second, should I be in a regional bank? I want to get out of here. And so you saw this mass transfer of deposits from regional banks to your JP Morgans and your Wells Fargo, et cetera, et cetera. And that's when Signature and First Republic really started to struggle. And so, and that's really the story of those regional banks.
And then around about the same time, I guess, when you have this crisis of confidence, you have Credit Suisse also running into financial difficulty. But as I understand it, it wasn't exactly for the same reason.
No, it wasn't. I mean, the timing was unfortunate. I mean, there are some related aspects, but I think, if you look at Credit Suisse, if you had to say in a sentence, why it failed, I'd say it was because of more than a decade of just gross mismanagement. You look at any scandal which came out of the banking sector since the global financial crisis, it seemed that Credit Suisse's name was attached to it, whether it was money laundering for the Japanese banks or Bulgarian drug lords or helping Americans evade tax. And then, created this culture of no one being accountable. And if you looked at the risk that they started taking on, I mean, any hedge fund which exploded, who was one of the largest shareholders, it was Credit Suisse, whether that was Greensill in the UK or Archegos in the US. And, so when you have this crisis swirling around in the US, and then Credit Suisse comes out and says, we've had some material weaknesses in our financial reporting, that's enough to scare anybody. And then their largest shareholder, which was the Saudi National Bank, said, listen, we're done. We're not going to be bailing you out anymore. It doesn't take a lot for people to say, okay, right, now it's time to get out of Credit Suisse and go somewhere else. And so, the Swiss National Bank had to step in and essentially, long story short, had to broker a deal where UBS would take it over. And UBS got it at a steal. I think at Credit Suisse's prime, it was worth about 100 billion francs. This is at its prime, so quite a long time ago. And I think it sold it to UBS for 3 billion.
Oh, wow.
So, they really did get a good deal. But I think the thing that worries me there is you've all heard the phrase, too big to fail. Now you've got this mega interconnected global bank. And my question is it too big to save if things do start going down? But like I said, I think it's, unless we have an extreme collapse of confidence, I think the banking system is certainly far healthier than it was in 2008.
Okay, and so in the last few months, we've had a regional banking crisis in the US, Credit Suisse blowing up in Europe, and I start getting a little bit uneasy about banks. And then I look at the Orbis portfolio and I see, well, there's quite a few banks. So maybe you can just unpack how your banks are different, or how you think they're different.
We have a bunch of banks, and if you look at it, it's an eclectic bunch of Japanese, Korean, and Irish banks. And, they don't have the same characteristics of Credit Suisse or SVB. I mean, you look at their depositors base, and it's mainly retail depositors. So, folk like you and me, where if we disappear from our bank, it's really not the end of the world. They keep sort of a lot more cash on hand, and what they invest in bonds, they invest in more short-dated paper. And if they do have any interest rate exposure, then they would do the necessary interest rate hedging. And I think another thing which I'd point out is that they're all the biggest banks in their respective markets, and so the regulator has their eye on them. And so no shenanigans like Credit Suisse or the shortcomings of SVB. So very happy to hold them, and they are extraordinarily cheap. I mean, you look at our Korean banks, and they are the cheapest non-distressed banks in the world. Very simple, exactly what a bank should be doing. And in Korea in particular, one thing we're excited about is that those stocks have been cheap for a while, and what we're seeing now is a change in policy where before they would barely pay out any dividends. And that's slowly changing, and we are engaging with management, and that looks like it's heading in the right direction. So we could see far better dividend yield going forward.
The one aspect I might disagree with you is you said they were the cheapest banks in the world. I would caveat that as an
developed
investor,
market
yes,
banks.
As an investor in Frontier in Africa, we do find also banks that aren't distressed trading on similar or even lower multiples. But I guess that's for a very different.
But just out of interest, what would the price to TNAV be on those kind of banks?
So, I mean, if you look at Frontier, our two biggest investments are in Halyk Bank, which is the largest bank in Kazakhstan, and then we also own TBC Bank, which is effectively two banks in Georgia. Georgia, the country that's just south of Russia, as opposed to Georgia, the state in the USA. So Halleck trades at around 0.6 or 0.7 times price to book, but its ROE has been consistently over 25% the last decade. And it's grown earnings anything between 10 and 20% per annum over that same time period. And so it trades on a P multiple of less than 4 times. And listener, for those of you that are unfamiliar with the terms, ROE means return on equity and PE is the price to earnings multiple. And then TBC is a little bit more expensive on a price to book basis. So at the moment it trades just over 1 times price to book. But also coming out of, if you look at the history of Georgia, emerging from communism in the early 90s, massively low in terms of banking penetration. They've also been growing 35% market share, very well capitalized, growing earnings in dollars, also similar to kind of Halleck, 10 to 15% per annum over a very long period of time. The last few years have been even better, funnily enough, but trading on around 4.5 times what we think are normal earnings.
That is extraordinarily cheap, but the Korean banks aren't too far from that. And the liquidity?
No, the liquidity is very different. I mean, these are much, much smaller banks. So I think the market cap of TBC is about $1.7 billion.
So, it's been fascinating to watch this sort of, mini banking crisis. And the good news about that is when you have these things, it always gives you an opportunity to buy something else. And that's what we've been looking around, what else can we add to? And so, one of the positions that we have added to quite significantly, because it's a company that we know well and we did already have a small position in it, was Interactive Brokers, which behaved like a bank to a certain extent during the mini crisis, but certainly doesn't have the characteristics of it.
And the kind of 60-second summary of why Interactive Brokers is attractive?
So Interactive Brokers, I mean, I don't know if you do any of your own trading, if you have your own personal account, but if you don't and you're looking to open up one, Interactive Brokers is by far the superior product, right? You get access to markets all over the world, and that the price that you're paying for your trades are just the value for money working through that compared to, say, a TD Ameritrade or a Schwab is just considerably better. And, what they're going for there at Interactive Brokers is kind of like the Costco model that Costco went for in the US, where they cut out the middleman. And so you got far fewer people that it passes through, and the savings that you make are passed on to the customer in the hope that brings, more people to the platform, et cetera, et cetera. So that's kind of the flywheel that they're trying to build. And so, their founder, Thomas Petterfee, I think he's got, it's exactly the kind of business we're looking for, a person who's founded it, still in it, still owns a whole bunch of it, and is still passionate about it. So, also has $4 billion of net cash. It doesn't have the duration mismatch that an SVB would have, or any credit risk at all. So, very happy to hold it.
It's interesting. Matt, I think we're almost out of time. So we've spoken quite a lot about all the various opportunities that Orbis is finding around the world. If you had to just finish off the conversation with how you think the opportunity set for Orbis today over your roughly 20-year career?
So I think I'll give 2 answers to that. How excited are we about absolute return? And then how excited are we about relative return? In other words, absolute return, is your investment going to go up? And relative return, is Orbis going to beat the benchmark? And I think on an absolute return perspective, I'd say we are, quite mediocre, maybe a 6.5. And this is South African grading, not American grading, where everyone
That's
gets...
out of 10, not 100.
Yeah, exactly. 6.5 out of 10. But then on relative return, I think we, 9 out of 10. Really excited about this sort of bifurcated market and great old economy value stocks that we just think are fantastic and that we're happy to hold. And then if you look at what we don't own, we're also very happy not to own that stuff. So when this all is said and done and things normalize, I think the Orbis funds will do very well.
Great. Thank you, Matt. It's been a pleasure chatting to you.
Thank you. I appreciate you hosting me.
We chatted through the current market shift and explained why Orbis are well positioned to do well in this environment. We also touched on why we believe that the value run is far from over, and we talked through some of the factors that have made it a very exciting time to be an active stock picker. To share your thoughts on this episode, you can send an email to info@allengray This podcast is available wherever you enjoy listening to podcasts. Hit subscribe on your favorite podcasting platform to be notified of new episodes. Lastly, Allan Gray is an authorized financial services provider. To view the terms and conditions and explore our latest insights and investment offering, please visit allangray.co.za. Until next time, I'm Rory Katiska Jacobson from Allan Gray. This podcast was produced by Volume. Thank you for listening.